Hey everyone, David Rose here from USXP. We got a new blog post out today on the economics of venture capital. The basics break down like this. General partners from venture capital firms will go out and raise money from what's called limited partners, who are typically high net worth individuals, university endowments, those type of things. And they will hold that money for 7 to 10 years. That's called a fund life cycle. And the basic economic model is called a 2 and 20 model, where the venture capital firm will collect a 2% management fee on funds under management, and they keep 20% of what's called the carry, or the profit, when exits happen in their portfolio and their startups. And they pass the 80% back on to their limited partners. Now, the biggest obstacle that venture funds have in raising venture capital is they have an IRR, or internal rate of return, hurdle rate that needs to exceed the S&P 500 return index in the US, which typically returns 8 to 10% annually. So VC returns typically are pitching 25 to 30+% returns on the money under management. The challenge is, now the venture capital community is opaque at best, not publicly traded, so we don't have good data, but most of the information we see says only about 25 to 30% of venture capital firms hit their IRR rate for their LPs. So what you need to know as a startup founder is a couple of things. One, the general partners in the venture capital firms are under tremendous pressure to generate returns. If they can't, they essentially go out of business. They can't raise another fund. But most importantly, you need to know the first thought that a general partner at a venture capital firm has in the morning is not, I hope I get to meet a really innovative startup founder today. It's almost certainly, oh my gosh, how in the world am I going to deliver a 30% plus return? Anyway, the more you know as a startup founder, the better off you are. Check out the blog post, and if you have any questions, let us know. Have a great day. Thanks.